Hey guys, welcome back to my YouTube channel Indias by Sharwan. So in the earlier video we have discussed about the recognition and de-recognition of financial asset or financial liability from your books of account. So in this video we will going to discuss about the classification of financial instrument. So how to classify the financial instrument into the different category. So before to start the video, I want to tell you in this video I will going to tell you you have to classify the financial asset into the three category: amortized cost, fair value through other comprehensive income, fair value through profit or loss. But in this video we will not going to discuss about the accounting treatment in case your asset fall into these different categories. So accounting treatment we will discuss in the next video, where we will cover our chapter number 5, which is regarding the measurement of financial instruments. So remember that accounting is different concept. We will discuss it in the next video. So we will just discuss here if you have the financial asset, so how to classify it into the different segment which is covered or which is itself described into the Ind AS 109, which is just corresponding to the IFRS 9. So now we should start our topic. So now financial asset, remember that financial asset would be classified into these three categories. Financial liability will be categorized into different category. We will see it in the next clip. So now financial asset will be categorized into these three categories. First category is amortized cost, second category is fair value through other comprehensive income, and third category is fair value through profit or loss. So amortized cost, classification of financial asset into the amortized cost, is given in para reference number 4.1.2, and para reference number 4.1.2a is regarding the classification of financial asset into the fair value through other comprehensive income, and then paragraph number 4.1.4 cover when you can classify the financial asset into the fair value through profit or loss. Remember that we will not going to discuss how to give the accounting treatment. I will going to tell you amortized cost, but what exactly is amortized cost, or if you have amortized cost, then how to break down your financial asset or how to calculate it, we will discuss in the next video. So don't confuse it. If you have financial asset, then you have to classify into the different categories. So remember that those principles which I will going to tell you in this video is regarding just the classification. Alright guys, so para number 4.1.2 says that a financial assets shall be measured at amortized cost if both of the following conditions are met. First condition is the financial asset is held within the business model whose objective is to hold financial asset in order to collect the contractual cash flows, and the contractual terms of the financial assets give rise on the specific date to cash flows that are solely payment of principal on the principal amount outstanding. So now you can see there is a two condition. First one is that you hold the asset in order to collect the contractual cash flows from that asset, and second condition is that the cash flow which you are generating from that financial asset are the solely payment of interest and the principal. So now first thing is what is the business model exactly, and when you can say you are holding down that financial asset in order to collect the contractual cash flow. So para number B4.1.2a of appendix B, which is the application guide, give you the idea what exactly is the business model. So para B4.1.2 says that an entity's business model refers to how an entity managed its financial asset in order to generate the cash flow. So how the entity manage its financial asset so that those entity can generate the cash flow is referred to business model. So what is the exactly motive of you or motive of the company to hold down the financial asset? So that motive is called the business model. So that is the entity's business model determines whether cash flows will result from collecting contractual cash flow, selling financial asset, or both. So if your objective is to generate the cash flow by holding down the financial asset or selling down the financial asset or both, so that intention will be called business model. So if you have the business model whose objective is to just hold down the financial asset in order to collect the contractual cash flow, then it will be called it will be classified into the amortized cost. So that's how the business model work. But exactly when you can say like you are just collecting or you are just holding down the financial asset in order to collect the contractual cash flow, when you can say. So para number B4.1.4 give you another example like when you can say like you are holding down the financial asset in order to collect the contractual cash flow. So there's a lot of example, but because we have the limited time, so we will only discuss the example number 1. So like an entity holds investment to collect their contractual cash flow. The fund need of the entity are predictable and maturity of its financial assets is matched to the entity's estimated funds need. The entity performs credit risk management activity with the objective of minimizing the credit loss. In the past, sales have typically occurred when the financial assets credit risk has increased such that the assets no longer meet the credit criteria specified in the entity's documented investment policy. In addition, infrequent sales have occurred as a result of anticipated fund need. Report to key management personnel focus on the credit quality of the financial asset and the contractual return. The entity also monitor fair value of the financial asset among other information. So in this example, you are holding down the investment to collect the contractual cash flow, but you also sold down the contractual cash flow because when you are in the position like you have the doubt because that asset is no longer generating the good return, so you also often sell down those assets. So analysis of this is like that. Although the entity consider among other information the financial assets fair value from the liquidity perspective, if the entity's objective is to hold the financial asset in order to collect the contractual cash flow, sale would not contradict that objective if they were in response to an increase in assets credit risk. For example, if the asset no longer meet the credit criteria specified in the entity's documented investment policy, infrequent sale results from the unanticipated fund need also would not contradict that objective even if such sales are significant in value. So analysis like that, you are holding down the financial asset and you sometimes sales because you have the risk that you have the credit risk in respecting or in respect of those financial assets. So selling down those financial assets would not contradict the objective of holding down the financial assets. So therefore you can in this example say like you are holding down the financial asset in order to collect the contractual cash flow. So there's a lot of examples, so you can read it by way of this. So now you can understand like when you can say your contractual, like your financial asset is holding down to collect the contractual cash flow. But what is the second condition? Like cash flow are the solely payment of principal and interest. So how you can say like your interest or your cash flow is a solely payment of interest and principal. So para reference number 4.1.3 says that for the purpose of applying paragraph number 4.1.2b, the principal is the fair value of the financial asset at initial recognition. So principal value is just the fair value of the financial asset at the initial recognition, and the interest consists of consideration for the time value of money for credit risk associated with the principal amount outstanding during a particular period of time, and for other basic lending risk and cost as well as the profit margin. So paragraph number B4.1.7a and B4.1.9a to B4.1.9e additionally provide you the guidance, so we will also look at it. So basically the interest interest consists of time value of money plus the credit risk plus basic lending risk plus cost plus profit margin. So there is a 5 component of the interest. So therefore principal plus interest, if that the cash flow is the solely payment of principal and interest means like this 5 component, then we can say like this is the cash flow which is the solely payment of principal and interest. So if the contractual cash flow, like you are holding the financial asset to collect the contractual cash flow and the contractual cash flow is the solely payment of interest and principal, then you will recognize it into the amortized cost method. So paragraph number B4.1.7a additionally give you the guidance, like when you can say your cash flow is the solely payment of principal and interest. So contractual cash flow that are solely payment of principal and interest on the principal amount outstanding are consistent with the basic lending agreement. In a basic lending agreement, consideration for time value of money and credit risk are typically the most significant element of interest. However, in such an arrangement, interest can also include consideration for other basic lending risks and costs associated with holding the financial asset for a particular period of time. In addition, interest can include the profit margin that is consistent with the basic lending agreement or arrangement. So this thing is just like what we have saw into the previous paragraph, like interest component include the time value of money plus credit risk plus other basic lending risk plus cost plus profit margin. So these are 5 component of interest. So if this component is included in the interest, then we can say okay, that is the interest component. But if there is another component which is not related to these 5 component, then we can say those cash flow is not the payment of interest and principal. So how we can say, another thing is saying you however, contractual term that introduce exposure to risk or volatility in the contractual cash flow that is unrelated to the basic lending arrangement, such as exposure to change in equity price or commodity price, do not give rise to a contractual cash flow that is solely payment of principal and interest on the principal amount outstanding. So basically, if the contractual term is giving you or the person is charging you another kind of a thing, those contract is regarding, or those contract is saying the term which is totally unrelated to the interest component, like they are linking the payment with the equity index or they are linking the payment with the commodity price, then we can say that is not solely payment of interest. So another example is given in paragraph number B4.1.14, which is instrument number G. So here the instrument number G is regarding those cases where you can say the payment is not solely payment of principal and interest. So it is the example when you can say this payment is not the solely payment of interest and principal. So instrument G is a loan that pays an inverse floating rate interest, that is the interest rate that had inverse relationship to the market interest rate. So instrument G is a loan but that pays you an inverse floating interest rate, those interest rate are inverse or which is totally different from the market interest rate. So now you can see analysis, the contractual cash flow are not solely payment of principal and interest on the principal amount outstanding. The interest amount are not consideration for the time value of money on the principal amount outstanding. So obviously, because those person is paying you something different thing which has nothing to do with the market interest rate. So in those cases you can say your interest is not or your cash flow is not the solely payment of interest and principal. So in those cases it will not be categorized into the amortized cost. So remember that how it will work. And if you want another example, then instrument number F. So into instrument F is a bond that is convertible into fixed number of equity instrument of the issuer. So analysis, the holder would analyze the convertible bond in its entirety. The contractual cash flow are not payment of principal and interest on the principal amount outstanding because they reflect a return that is inconsistent with the basic lending agreement. That is, the return is linked to a value of equity of the issuer. So because you issuer is giving also you the right to convert those bond into the fixed number of equity instrument. So therefore this cases is also not the payment or solely payment of interest and principal. So in those two cases we can say those cash flow is not the solely payment of interest and principal, and in those cases you have to now means your your financial asset cannot be categorized into the amortized cost. So remember that those two conditions is that you hold down the financial asset in order to correct the contractual cash flow, and we have seen the example like when you can say that you are holding down the financial asset in order to collect the contractual cash flow, and also cash flow should be the solely payment of interest and principal. And we have also discussed in our example like when you can say those cases is not the solely payment of interest and principal. Now we should move our next category, which is like the fair value through other comprehensive income. So when you will categorize your financial asset into this category. So again, here is the two situation which is given in paragraph number 4.1.2a. So first situation is like when you held down the financial asset to collect both the cash flow and to sell it down. So if your objective is to both collect contractual cash flow plus sell it down, means if you are selling it and if you are also collecting the cash flow, and the cash flow are the solely payment of interest and principal, then you will recognize it or you will categorize it into this category, which is the fair value through other comprehensive income. So in this case, like this situation is similar in both two cases, but from this situation is like in amortized cost you just hold down the asset to collect the contractual cash flow, but here you also hold down the the financial instrument in order to collect the contractual cash flow, plus you also have the objective to sell it down whenever you feel like you have to sell it down. So for example of the cases, like when you can say you are holding the asset for collecting the contractual cash flow and also to sell it down. So example is also given in paragraph number P4.1.4c. So example number 6 of this paragraph number is like this. It is an example of when you can say like you are holding down the financial asset in order to both collecting the contractual cash flow and to sell it down. So a financial instrument holds the financial asset to meet its everyday liquidity need. The entity seeks to minimize the cost of managing those liquidity needs and therefore actively manage the return on the portfolio. That return consists of collecting contractual cash flow as well as gain or loss from the sale of financial assets. So now here you can see like you have the two motive, collect the contractual cash flow as well as the gain or loss from the sale of financial asset. So easily it can be recognizable that your objective is both selling down the financial asset and also to collect the cash flow. If you want to check out the analysis, the objective of the business model is to maximize the return on the portfolio to meet everyday liquidity need, and the entity achieve that objective by both collecting cash flows and selling the financial asset. In other words, both collecting cash flows and selling financial asset are integral to achieve the business model's objective. So in our example, we have now see that when you can say like your financial asset is to both collecting the cash flow as well as to sell it down. Like in this example, the portfolio manager is like collecting the cash flow and also sell it down to meet the daily liquidity need. So he are just collecting the cash flow and also means whenever he sees like there is a fair value changes, like fair value has been increased, he also sell it down to collect the gain or loss from that investment. So now we have seen it, and those second situation is similar, like when the cash flow are solely payment of interest and principal. So in these cases we have to measure it or classify it into fair value through other comprehensive income. Now moving on to the third category, which is the paragraph number 4.1.4 says that those category or those financial assets which cannot be recognizable or which cannot be classified into amortized cost or fair value through other comprehensive income, then those cases will be fall into this situation. But there is also another like you have also the option, like if suppose your cases is falling down into this category but you want that you should classify your financial asset into this category, which is the fair value through other comprehensive income, then you can categorize your financial asset into the fair value through fair value through profit and loss account. So two situations, if you don't want to categorize it your financial asset into these two categories, then you have the option to classify it into the fair value through profit and loss. Or if your financial asset is not classifiable into these two categories, because like your financial asset is neither to collect the contractual cash flow and neither to sell it down, then your cases will be fall into this category. And if those cases where the contractual cash flow is not the solely payment of interest and principal, then those cases will also be fall into this category. But what about the equity instrument? Like you invest the equity, you invest your money into the equity instrument of some company, like you purchase the equity instrument or the shares of another company. Now what will be the classification? So because in our example, like equity instrument, so basically the cash flow will not be solely payment of interest and principal, because you receive the dividend. So in our equity instrument, the equity instrument cannot be classifiable into those two cases. But paragraph number 4.1.4 also says that, however, an entity may make an irrevocable election at initial recognition for particular investments in equity instrument that would otherwise be measured at fair value through profit or loss to present subsequent change in fair value in other comprehensive income. See paragraph number 5.7.5 to 5.7.6. So basically he is saying, like if your equity instrument would be fall into the fair value through profit or loss account, because obviously the cash flow would not be solely payment of interest and principal, but you want or you make the irrevocable election at the initial recognition for particular investment in equity instrument to present the subsequent change in fair value in other comprehensive income, then you can do it. So basically you have the option, like in equity instrument you can elect at the initial recognition, like you want to classify your equity instrument into the fair value through other comprehensive income instead of fair value through profit and loss account. So basically in equity instrument you have the two choice. If you want to elect to change or if you want to elect that your equity instrument should be classifiable into the fair value through other comprehensive income, then you can classify it into that category. If you don't want it, then you can classify into fair value through profit or loss account. And also if you want to check out like paragraph number 5.7.5, so 5.7.5 says that at initial recognition an entity may make an irrevocable election to present in other comprehensive income subsequent changes in the fair value of the investment in an equity instrument within the scope of this standard that is neither held for trading nor, I am not gonna read it because that is irrelevant for you. So if you want to elect, or if you want that irrevocable claim to present in other comprehensive income subsequent changes in the fair value of the investment in equity instrument that is not held for trading. So if your equity instrument is not held for trading and you want like your equity instrument should be classifiable into fair value through other comprehensive income, then you can classify into other comprehensive income. If don't want to elect it because your investment in equity is held for trading, then you have to classify it into the fair value through profit or loss. So basically if don't held for trading, then categorize it into the fair value through other comprehensive income, but if held for trading, then simply fair value through profit or loss account. So that's how the classification will work. Amortised cost, fair value through other comprehensive income, and fair value through profit or loss account. So if you want to also check out the flow chart, like how this system will work, then you can also check out the flow chart which is right now into your screen. So this will goes like this. Like first option is like the instrument within the scope of Ind AS 109. So if that instrument is within the scope of 109, then contractual cash flow are solely principal and interest. So if contractual cash flow are solely interest and principal, and if you want to say yes, then held to collect the contractual cash flow only. And if you want to say yes, then you have the option like you want the fair value option. If no, you don't want the fair value option, then classified it into the amortized cost. But if you want the fair value option, then categorize it into the fair value through profit or loss. Again, if the contractual cash flow are solely principal and interest, or yes, if contractual cash flow are solely principal and interest, yes, and it is held to collect the contractual cash flow only, then you will say like no, it is not held for contractual cash flow only. You held it to collect contractual cash flow and for sale. If you want to say yes, then fair value option you want to opt it. If you are saying no, I don't want to have a fair value, then you will classify it into the fair value through other comprehensive income. But if you want to check out for the fair value option, then obviously classification will be fair value through profit and loss account. And if the contractual cash flow are not solely payment of interest and principal, then obviously it will move down to fair value through profit and loss account. So basically in these cases, like if the contractual cash flow is to holding down the contractual cash flow, and the contractual cash flow is the solely payment of interest and principal, amortized cost. If the contractual cash flow is like holding the financial asset for collecting the contractual cash flow and to sell it down, and cash flow are the solely payment of principal and interest, then fair value through other comprehensive income. And if those two cases is not applicable in your cases, then fair value through profit and loss account. So that's how the classification of financial asset will work. Now what about the classification of financial liability? So paragraph number 4.2.1 says that an entity shall classify all financial liabilities as subsequent measured at amortized cost. So all financial liability will be measured at amortized cost, except for financial liability at fair value through profit or loss. Such liability, including derivative that are liability, shall be subsequently measured at fair value. So basically in case of financial liability, there is only two options. First one, amortized cost. Second one is that fair value through other fair value through profit or loss. So there is no option of fair value through other comprehensive income. So in case of financial liability, you cannot classify your financial liability into fair value through other comprehensive income. So just two category: fair value through other fair value through profit or loss, or amortized cost. So this is how it's gonna work. So classify the financial asset and financial liability like what I have said to you. So now you have learned like when to classify the financial asset into the three different categories like amortized cost, fair value through other comprehensive income, fair value through profit or loss. There is a talking of like principal amount, interest amount, and then holding down the financial asset or selling down the financial asset. So there is a lot of talk, but you want the example like how into the real world your financial asset or liability will be classified. So you want like you are now checking or you are thinking right now your balance sheet picture and what component will be categorized in which category. So here's the list like liability and asset. Here's your balance sheet, and I am just going to tell you like how to classify your financial asset or liability into your balance sheet. So now first, in liability side there is the equity share. So remember that equity share is not a financial instrument, so therefore the classification will also be not applicable. Second, loan. So you know that financial liability can be only categorized into two components: fair value through profit and loss or amortized cost. So remember that your loan which you have received from the bank will only be classified into amortized cost, not the fair value through profit and loss. So remember that. And the criteria is like the solely payment of interest and principal, and like the holding down the financial asset is not applicable in case of a loan, because loan is a financial liability, and in case of financial liability only two classification is there: amortized cost, fair value through profit and loss account. So remember that just amortized cost method will be used for your loan liability when you are in the liability to or you receive the liability of the loan. So remember that there will be no talking like the principal amount payment or holding down those financial asset or liability. So no, just classify it into amortized cost, your loan liability which you have taken from bank or other person. Then derivatives. So now you have the financial or you have the liability regarding the derivatives. So remember that all the derivative financial liability will be measured at fair value through profit or loss account. So therefore there will be no amortized cost in the case of a financial liability. Remember that, just two categories here. The liability side is very clear or very simple. So now talking about the asset side. So now you have now given the loans and advances to some person. So you know that loans and advances can be categorized into the three different categories: amortized cost, fair value through other comprehensive income, and fair value through profit or loss. So now if your loans and advances which you have given to some person and you just given to some person, and yes, you want just to receive the contractual cash flow and you don't want to sell it, you just want to receive the contractual cash flow, and the contractual cash flow is just a solely payment of principal and interest, then amortized cost. And if you are holding down the financial asset or you holding down the loan, and also you can sell it down the loan to some person because you have now the risk, like those person cannot pay the you are in the risk, like those person to whom you just gave the loan will not make the payment, that you want to sell it down. So if your intention is like to sell the loans advances to some other guy and also to receive the contractual cash flow, and the contractual cash flow is just the solely payment of principal interest, then fair value through other comprehensive income. But if those cases will not be applicable because the contractual cash flow is not the solely payment of principal or interest, then fair value through profit or loss, your loans advances. Next category is like the investment in equity share. So you know that in case of investment in equity share, amortized cost cannot be happen, because in case of equity share the contractual cash flow cannot be solely payment of interest and principal. So therefore two categories there. If held for trading, if you are in your investment in equity share is held for trading, then recognize it into fair value through profit or loss. But if not held for trading and you are opting like those cases which I just read it out for you, like you at the initial recognition you just make the irrevocable election to present the changes in the fair value through other comprehensive income, then categorize it into fair value through other comprehensive income in case your investment in equity is not holding your investment in equity for trading purpose. And then investment in bond and debenture. So again same thing is there, it can be amortized cost, fair value through profit or loss, fair value through other comprehensive income. If your objective to holding down the bond or debt is just to receive the contractual cash flow and the payment is the solely payment of interest and principal, amortized cost. And if the holding down the financial asset or objective is just holding down and you can also sell it down, and the payment is just the solely payment of principal and interest, then fair value through other comprehensive income. In case you also want to sell it down and the principal amount and payment is not the contractual cash flow, then fair value through profit or loss account. And in case of a derivative asset, then remember that derivative will always be categorized into other fair value through profit or loss. It cannot be measured or classified into amortized cost or fair value through other comprehensive income. So that's how it's gonna work. So now I think you now clarify yourself how to classify your financial asset or liability into your books of account. So remember that this segment or this chapter is just for the classification. Now what exactly is the amortized cost and how to do the calculation in case of an amortized cost, we will discuss it into the next video, where we will discuss about the measurement of financial instrument. So if you have any doubt, then ask me on the comment section. I will reply it by way of a separate video, and subscribe the channel for getting the more such kind of a beautiful video in the future. I think the video is too long, but it's worth watching the full video. Alright guys, so now we will meet again in our next video. Till then, bye bye.